Good morning. I'm Steve Osier with ContraVest, and we're in the commercial real estate business. And today I want to talk about private investing. I will certainly use commercial real estate apartments to demonstrate a few financial concepts that I think are important. But we've built over 27,000 apartment units in excess of $2 billion in value, and we think we know a thing or two. In any investment, there's only two forms of financing. That's debt and equity. There's a couple different flavors of debt and a couple different flavors of equity, but at the end of the day, it just comes down to those two forms of financing. So we've got equity and we've got debt. When we evaluate an apartment deal, there's three metrics that we look at. We look at the return on cost, return on equity, and internal rate of return. And when we evaluate a deal, for example, in the commercial real estate and apartments, the return on cost that we're targeting is 6.25 to 7% return on cost. I'll go into the example of how we calculate that. Typical return on equity, which sometimes is referred to as cash on cash return, you may hear that expression, is usually between 8 and 10% is what our typical investors are looking for. The internal rate of return that we're targeting is between 18 and 20% internal rate of return, or referred to as IRR. We'll explain how we get into the IRR, but you can only calculate the IRR on any investment after you've exited the investment, whether it be a stock purchase, a business ownership, or commercial real estate, which we're going to talk about. I mentioned the debt and equity. So when we finance an apartment community, this is called the capital stack. Capital stack consists of debt and equity. So typically, the equity component of the cost of a commercial real estate deal or any investment, you have the equity and the debt. The debt typically comes from a bank, and equity is usually just cash, which typically comes in from an investor. On our current apartment deals, the first thing we want to do is calculate the cost. So the return on cost, we have to know what our cost is. So when we go to look at the cost, first thing we do, for example, in an apartment community, let's just assume a 300-unit apartment deal. It costs us about $250,000 a unit. That's all in, includes the land, construction cost, interest reserve, insurance, etc. Is $250,000 a unit. So that would equal roughly $75 million to do an apartment community. Now you can use all cash, $75 million, and build it, or as I mentioned, the capital stack. So today, typically the debt moves. The debt, we could do a whole other class on debt itself. Today, it's roughly about 55% of the cost of the project, and the remaining part is equity. So when we look at the return on cost, we've got our total cost of $75 million. So next we need to look at what the income is. Okay, so we'll take our apartment community. We've got the income. We assume we built 300 apartment units. Let's assume a rate of $2,100 a month, $2,100 a month. Now, everything in the finance world or investment world is annualized. So when we look at return on cost, that's an annual return. Cash on cash or return on equity, that's an annual return. So we take 300 units, we rented them all at $2,100 times 12. The gross income for this project would be $7,560,000. We have expenses to pay, we have some vacancy and the like. Typically in our apartment communities, we run at about 33% expenses. Again, when you're looking at a different commercial real estate investment or any other business, you need to know what the percentage of expenses typically are. In our business, we're usually running between 30, 35%, 33%, depending on taxes, depending on insurance and the like. So for us, this is the expenses. So we collect the rents, we pay our expenses. What money do we have left over? In this case, your NOI, your net operating income, is $5 million. This right here is the magic number in commercial real estate, specifically apartments. Other businesses, this would be referred to as your EBITDA, your earnings before interest, taxes, and amortization. So again, if you're looking at another type of business, you would want to say, hey, what is our gross income? What are the expenses? Are they real? And then what's left over is your EBITDA. So first metric is return on cost. We know what our cost is. We know what money is left over, and this is what we consider our unleveraged return, because we're not talking about debt. We paid all cash, and we know what our income is. We use a small formula. It's pretty simple. We divide it by the value, which is what it costs us to build the project at $75 million, and we, in this case, our return on cost, we take the income, which is right here, divided by the value, which is our $75 million. So the return on cost is 6.75. So in this case, we fall right in between where it would be expected for the return to be acceptable to investors. So that's what our return is. We took $75 million, threw it in the ground. Apartment community came out. We were able to rent the units for $2,100 on an annual basis times 12. Our gross income would be $7,560,000. We have to pay our expenses, pay taxes, pay insurance, pay the staff. What money's left over? $5 million. What is that as a percent of the total value, which is what it cost us to build the project? So that would be a 6.75% return on your cost. So in our industry, there are investors who are not comfortable with the risk associated with construction. Well, it costs $75 million. They're not comfortable with the risk of lease up and administering the lease up of a new project. But they do like the income. They do like the asset class. So what happens in our business is investors will come in and you're like, okay, what's the project really worth? Well, what happens is another investor comes in and they say, hey, I really like this $5 million. I'd like to buy that. But those investors have a lower tolerance for risk, so they get a lower return on their money. So you try to say, well, hey, what's it worth? So there's basically a little algebra formula where you want to try to find out what it's worth. We know what the rate is. The investor comes in and they pay what's called a cap rate, a capitalization rate. So they're taking their money and they're trying to capitalize that at a certain rate. So for example, this investor comes in and says, hey, I know you're making 6.75 on your cost. I only need to make 5.5% on my cost. So I will pay you a certain amount of money based on this cap rate. So they take basically the $5.5 million. They know what their return expectations are. They're 5.5%. And so they're willing to pay us basically $92 million. So in essence, we have created value based on what we know the return on cost is and what investors are willing to pay in the market. So the lower the cap rate for us, the higher somebody's willing to pay us. So we built it for $75 million. Somebody's willing to pay us $92 million. Okay, so in essence right here, obviously 92 minus 75, we have a $17 million gain on this project. So to compare it to what you would see in other businesses, this cap rate is 5.5%. So commercial real estate is basically valued on a cap rate. Other companies, maybe software companies, manufacturing companies, et cetera, they're usually evaluated on a multiple of their EBITDA or NOI. So for example, we were to convert this cap rate to a multiple, it'd be about 18 times NOI, what the value is. So let's see what this would be worth if the cap rate went down, let's just say 4%, this project would be worth $126,500,000, and it costs us $75 million to build it. Somebody's willing to come in and pay us based on a 4% cap rate. The NOI didn't change, the rents didn't change, the expenses didn't change, but what the investor was willing to accept on their money did change. So now we have a value of $126 million. It costs us $74. That's a $54 million increase in value. So as this cap rate goes down, the multiple goes up as well. In this case, 25 times EBITDA or 25 times NOI. But again, we speak in cap rates. So how do you determine a cap rate? Well, each market is different. Cap rate in New York City is different than the cap rate in Orlando, Florida. Cap rate in Orlando, Florida is different than the cap rate in San Francisco. Investors have a different tolerance for what they're looking for their money. They call it a risk-adjusted return. If they find it to be a risky market, they might pay a higher cap rate. If they think it's a very good market, they'll be more aggressive because they know it's a less risky investment, so they're willing to accept a lower return. So that's really what the cap rate is. So, for example, the no-risk investment, some people consider the U.S. Treasury, the 10-year Treasury, 30-year Treasury, as a zero-risk investment. So they're willing to accept 3, 4, 5% on their money because it's basically zero risk. If you were to invest in an office building today, because of the high vacancy, remote working, investors want a higher return on their money, so they're only willing to pay on a higher cap rate. So anyways, that's how cap rates work in the commercial real estate business. And so the lower the cap rate, now when you're evaluating commercial real estate or any business, the key metrics that will affect the total value. Can I get $2,100 a month? Is the rent increasing or decreasing in that market? You need to evaluate that. What are the expenses? Are the expenses real? Is the promoter or the sponsor of the investment have real numbers in there and real expectations? You can get this information by talking to other industry professionals in our business, commercial real estate brokers, other industry professionals, other developers, to realize and understand whether the numbers are good. You can talk to banks. They'll let you know whether those assumptions are accurate or not. So this is how, again, an apartment deal works. This is a metrics. These are the metrics today. When I first got in this business over 20 years ago, the return on cost expectations on a new deal were between 9 and 10%. But as the value of apartment communities and the consistency of the income and the institutional capital that's come into it has pushed down the return expectations, because it has proven to be a very steady asset class for institutional investors, people looking for long-term income. So again, in our business, the value is created basically the difference between our return on cost when we go into the project and then what we feel like an investor is willing to pay or the market will recognize. So this is how we evaluate an apartment deal, and you can use this to evaluate any other commercial real estate. But the beauty of video and what we have today that's available, you can certainly pause the video, go back, but I do recommend that you do these calculations longhand. Certainly have the spreadsheets that are helpful for us to do it quickly, but understanding how to do this longhand with a 10-key calculator, that's how you really learn how to do this. It's not super complicated. It can be complicated, and I'm sure it will be presented in a complicated fashion. But if you can boil it down to these simple 8th grade arithmetic, understanding how to do, obviously, adding and subtracting and percentages and converting those over, that's the basic skills that you need. But I highly recommend that you do it longhand. Same type of calculation in retail business, commercial real estate, office commercial real estate, industrial commercial real estate, senior housing, and the like. So I'm showing you what it looks like in an apartment deal. These are the same metrics that you would use evaluating any commercial real estate deal, but also similar metrics you would use and calculations in evaluating any business opportunity. Certainly the operator is a big part of that, but understanding the metrics is even more important. So thank you very much, and I hope it was a good day, and we know it's a great day to build apartments.